Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Spotify added a record number of users last quarter thanks to its end-of-year Wrapped campaign. Shares surge.
Plus, Paramount enhances its bid for Warner Brothers Discovery, offering billions to cover termination, debt refinancing and ticking fees. Details this hour.
And Runway CEO Cristobal Valenzuela joins us to talk about the new funding round that values the company at $5.3 billion.
From private markets to the public markets. Look, on the benchmarks, nothing that exciting. We're holding on to gains, just eking out 23 points in the green on the Nasdaq 100. But you go underneath the hood, Ed, and that rotation continues. But this time, it's the hardware that gets sold off. The software is being bought for a third straight day. Software really up about 9% as we buy back into that beaten up sector. But we're looking also to what the macro picture is painting. We've got retail sales that come in less than had been expected. What does that mean for a Fed cut? What does it mean for equities? What does it mean for crypto? Because let's face it, that is where the movement's happening today. Bitcoin up by 1.6%. Look at ETH, down almost another 5% as we still question what sort of an asset this really is. What are you looking at?
I'm looking at Spotify, and shares are absolutely surging. A record number of subscribers added last quarter, taking the total to $751 million. Later in the show, we'll get to it with Bloomberg's Ashley Carman, but it was all about the end-of-year Wrapped. And I know as a team, we all exchanged our wraps. The stock was on track for its best day ever, up almost 20%, now on track for its biggest jump in about 7 years. But that is a big response to strength when it comes to music streaming, Karen.
It certainly is. Tell you what else there's strength. The bond market. We're looking at shares of Alphabet, but really I want you to focus on its debt because its bond offerings keep coming. And after the US dollar debt sale raised $20 billion yesterday, it was upsized. The company is now selling over $11 billion more in sterling and Swiss franc denominated bonds. And that super rare 100-year note we told you about yesterday, well, it was oversubscribed and then some, almost 10 times according to sources. Let's talk about it with Robert Schiffman from Bloomberg Intelligence. In less than 24 hours, they've raised $32 billion, basically, on the debt markets. Let's just focus in on what that 100-year debt signals about the confidence people have in this company.
Well, I think what the bond market is telling us is that AI bubble talks are so 2025. That the concerns that, at least from the creditor's perspective, is not anything near what it is from an equity standpoint. The reality, though, is what is the benefit of a 100-year bond? To me, it's just a trophy. It's going to be put on the shelf of pension funds and insurance companies. They're going to hold it to maturity. And let me tell you something. If anyone's really worried, if that bond does not pay off in 100 years, come and look me up at Bloomberg. I'm going to be upstairs in my office eating free snacks.
Robert, the macro point is that they're doing interesting things with capital. The bigger picture to fund CapEx, right? To grow AI infrastructure at scale. I always read your memo every morning, and you revise constantly the kind of trajectory. What are the latest numbers that you see going over the next decade?
Yeah, it sort of becomes monopoly money, the type of spending that we're seeing. I mean, we're now projecting over $4 trillion of cumulative hyperscaler spend through 2030. You can afford a lot of that from operating cash flow. However, how do you supplement it? You supplement it with really cheap bonds. And the way that you can do that is you start off with balance sheets that are in phenomenal shape. If you look at Alphabet's AA+ credit rating, S&P came out yesterday and said, in order to breach their downgrade trigger, they would have to issue more than $180 billion of incremental net debt. So what I would argue is, hey, if they wanted to be a BBB name, would they have to issue $1 trillion of bonds? There is so much capacity. Why not take the money down, borrow long-dated paper at 5.5%, 5.7%, put it to work today, and grow your future cash flows for another decade, if not 100 years?
There is some pushback in the market that, yes, it's a trophy on a pension fund's desk. Maybe it's a trophy on Alphabet's CFO and treasurer's desk if they sell 100-year bonds. But it also signals the top of the market. Look, we go back to when the last time a tech company did this. It was Motorola back in the 90s. And people are trying to make the assertion that maybe Motorola was at the peak of its game then, and where is it now? What do you say to those sorts of question marks about 100-year debt?
Yeah, listen, I think what's going to be the top? We can never call the top. Let me tell you something, though. I think there's more bonds to come. We still have Microsoft. We still have Meta. We still probably have Amazon.
But would they do 100 a year?
You know what? They might. And they also might do a lot of other incremental currencies like we talked about yesterday. I'm actually surprised they stayed out of the euro market. I think there's a big, deep demand. There is every portfolio manager that we are talking to is talking about having excess cash on hand. And everyone is looking at the same compressed yields. There is a bid for yield. It is not going away anytime soon. So if we hit the top of the market, I don't think it's today. Maybe it's next week. Maybe it's going to be in 3 weeks, but I don't think it's yet. Listen, I've never been as bullish on tech as I am today. I don't think these companies have ever been better positioned. I don't think their balance sheets have ever been better positioned. And I actually think the confidence levels that we see across the bond market far supersede what I think even Bloomberg News is talking about.
Robert Schiffman from Bloomberg Intelligence. Bonds are fun. Thank you very much. The software sector may have a chance to rebound. We're so closely tracking what's happening in software right now. According to JP Morgan strategists, fears of AI disruption may be overblown, and the current bearish sentiment is a, quote, overshoot at this time. That view is echoed by Lauren Webster, Managing Director of Investment Banking for Technology at Piper Sandler. She writes, while there is merit that AI will be a death sentence to certain sectors of software, the notion of software's broad obsolescence is overstated. Delighted to say that she joins us now. I mean, this is a day-by-day thing. Looking at some of the trading in action in the moment, I see a lot of green in the software space. But I say it every day, one market session a market does not make. Just go a bit deeper on your thesis and why you're a bit more calm here.
Absolutely. So I think where we are is in sort of this phase of forming, storming, norming in the market and the give and take between AI innovation and software stocks. And so you're seeing a lot of volatility, disruption each time there is a new product released from an AI innovator. Yet this broader realization that enterprise software is here for good. You can't rip it out tomorrow. And this is a longer term trend as we figure out how to embed AI into enterprise solutions. What is actually going to be disrupted?
We are canvassing a wide and diverse range of views on what's happening in software. Earlier today, we spoke to the Goldman Sachs CEO, David Solomon. Here's what he thinks.
We have software exposure, but I'd say it's insignificant in the scale of our overall platform, but it's certainly something that we're monitoring. I think the narrative over the last week has been a little bit too broad. There'll be winners and losers, and plenty of companies pivot and do just fine.
Sell off too broad. It sounds like you and Mr. Solomon agree that maybe what we've seen in the last 7 to 10 days, a little overdone.
Certainly. With that said, though, if I was running a business in the software sector today, I would be taking a hard look, spending time with customers, understanding how they're using AI in place of the products that I offer, where I should be embedding it, and certainly planning for the next decadal transition towards more AI infrastructure tooling. But yes, as I said, nothing is getting ripped out tomorrow, and this is a much longer transition period. And the good news in that is that it gives software companies time to catch up, figure out how they can play this opportunity.
Lauren, what data do you look to as to what might be being ripped out? What is a point of offering rather than a platform that's integrated more deeply within a business?
Yeah, certainly looking at those that have been disrupted most by recent product launches from whether it be Anthropic or others. Workflow tooling is a place at risk. Certainly there are elements within the legal sector that some of the newer announcements are starting to displace. There are, however, bright spots, like cybersecurity is one where I spend a lot of time, and certainly you need cybersecurity capabilities to even implement some of that AI enterprise infrastructure. So there will be pockets of opportunity in the software sector, and then certainly in the picks and shovels around AI infrastructure.
Go there a little bit more, because that was clearly the read across from some of this capital expenditure spend that we saw last week announced. I mean, extraordinary numbers coming from the hyperscalers. And then, of course, people thought, well, time to be long energy, time to be long the chips that go inside these data centers. Is that still the right play for you, Lauren?
Absolutely. So the money is not pulling out of the market and sitting on the sidelines. It truly is going into a lot of the infrastructure opportunity, what is often called the physical AI play, where it is energy, networking. I mean, we're even seeing physical security around data centers getting another look. And so there's a significant opportunity in that infrastructure and elsewhere that is, IRL or in the physical world.
What I'm trying to understand is why the story has changed for lots of investors. If you think back to when we started closely tracking capital expenditures, people wanted to see the software revenues on the other side. They wanted to see revenue top-line growth that directly resulted from AI investment, right? Think about the quarter gone, a name like Salesforce. They posted really good numbers, but the anxiety is still there, despite the evidence it's backward-looking, that people are willing to pay for that AI era of software. Why is that?
Look, there's a broad realization that you're going to have to invest ahead of the real realization of the opportunity, the real realization of the profits. And so that's why you're seeing a lot of these hyperscalers pour tremendous capital, hundreds of billions into their CapEx infrastructure associated with AI. And there will be support for others across the software ecosystem, as long as there is also that enterprise customer journey narrative going with it as well.
Yeah, that enterprise evidence is what we're looking for. I'm going to ask you one of my favorite questions, given we're still early in the year. What happens in the rest of 2026 with the software sector?
Yeah, I'm going to go back to where I started, which is really this forming, norming, storming. You have a lot of AI forming right now, and I will tell you, we are not at the end of that formation. There are going to be gives and takes, and then that storming with traditional software. The winner there is going to be those that are really spending time understanding the evolution of their technology with their customers and how those customers are applying AI to their solutions. And then you'll have this normalization, and it could be a few years out, where there's a balance between, AI infrastructure leaders and those software innovators, enterprise SaaS, who have really seized the opportunity to embed AI for their customer benefit.
Lauren Webster, can't wait to have you back on the show. Thank you very much indeed, Piper Sandler. We appreciate it. Coming up, Spotify reporting record user growth in its fourth quarter. What to discuss next? We're in these earnings, but Ed, what are you looking at?
Just a very quick look at TSMC's US listed shares. They're up almost 2%, 1.7%, but trading at a record high. The shares in Taiwan overnight traded at record highs. The revenue jumped 37% in January. Same story. AI spending marches on. TSMC dominates the market for chip manufacturing. This is Bloomberg Tech.
Checking on Spotify shares, having a strong day, up 15%, at one point having their biggest move on record after the company reported, record user growth in its fiscal fourth quarter and $835 million in operating income. Let's turn to Bloomberg's Ashley Carman, who broke down the numbers. And look, the mighty have fallen a lot coming into this number, Ashley, so the bounce back is perhaps not surprising when they're able to give some sort of ease to the investor base.
Yeah, and I think that was a lot of what this call was today, is just addressing concerns that AI, specifically AI music startups, these are supposed to launch this year. So people are concerned, are people going to start using AI to generate songs and then listen to those songs on other platforms, or are they going to keep coming to Spotify? And today, the co-CEOs were saying, we think they'll keep coming to Spotify.
So the stock at one point was up on track for its biggest jump ever. It's now up 15.5%, I think on track for its biggest jump in 7, almost 8 years. You write about in the report the impact of Wrapped. For those, although I don't imagine there's many that don't know what that is, Ashley, just explain it. But why was that such a big factor?
So Wrapped is their annual interactive viral marketing campaign where people share their music and podcasts that they listen to the most this year. And every year, it is just a moment on the internet. People tend to activate their service to participate in Wrapped, so they always expect to see a boost. But I believe on the call today, they said this was their biggest Wrapped ever, so we can really see the results of that marketing campaign.
But are people advertising more with Spotify? Are they able to drive revenues not just by having more of us tune in and unearth our Spotify account every end of year?
So this is the one part of the earnings today that was a little bit gloomy. The ad-supported revenue actually dropped year over year, and this has been a part of the business that people are really wondering, when are we going to see you start making more money from advertising? Which is also an important question, because when we're talking about them adding users, these are ad-supported users. Subscribers grew as well, but if you're going to keep adding ad-supported users, you also want to see the revenue in that department go up as well.
Bloomberg's Ashley Carman on Spotify. Thank you very much. Paramount is trying to sweeten its Warner Brothers bid. The media giant saying it will cover a $2.8 billion termination fee that Warner Bros. Would pay Netflix if it terminates an already agreed upon deal. Bloomberg's Lucas Shaw, who leads the Screen Time team, is with us. This was interesting, right? So the headline's here, and it's a sweetener, an improvement on their deal. But actually, the specifics are very interesting. They're not boosting the offer price. Go into detail, explain how we unpick this.
Yeah, so they are addressing, and they being Paramount, two of the concerns that Warner Brothers has had about their deal. One is this question of the breakup fee, right? So Warner Brothers had been debating between two main offers, between Netflix and Paramount. They picked Netflix, but if they walk away from Netflix to re-engage with Paramount, they have to pay Netflix a bunch of money. Paramount is now offering to cover that, and Warner Brothers had been very worried about it, because they said that one of the reasons that the deals weren't equivalent was Paramount wasn't kind of covering Warner Brothers' downside on that, which would have come out of the money that they get. The other thing here is Warner Brothers have been really concerned about their ability to refinance their debt going forward. Paramount has now, or David Ellison, both first in swallowing Paramount and now trying to swallow Warner Brothers, has a history of trying to impose really onerous kind of covenants on what the company he's acquiring can do, which would have limited Warner Brothers in that respect. And now Paramount is saying, basically, we'll cover you on whatever costs are related to that debt financing. To your point, they still haven't actually raised the $30 a share offer. This does increase the total net value of the bid, and so we're waiting to see what the Warner Brothers board has to say about it.
What credence do investors give at the moment, Lucas, to that this would pass through regulators more easily? This whole ticking fee, the idea that if it goes past the quarter expected, they get a chunk of change in return if it's delayed. I mean, that really just speaks to the bravado here.
Yeah, well, Paramount has been adamant all along that it stands a better chance of getting its deal approved, which on its face makes some sense. Netflix is a much larger company, a more powerful company. It's the #1 player in streaming. Netflix, of course, has countered that they're very confident in getting their deal approved and raised issues with Paramount's offer, because Paramount plus Warner Brothers Discovery combined would account for technically a larger share of television viewing than Netflix would under the deal. But both sides are trying to plead their case. Paramount obviously is sort of coming from behind here. And what they are trying to do is inject enough doubt in the minds of shareholders that they will not vote for the Netflix deal next month.
Lucas, both sides trying to plead their case. There's been a lot of recent reporting from us on what's also happening kind of in the background. There's obviously been an interest from Washington, D.C. What else do we need to know about how this is going from a regulatory perspective, or at least interest from government as well?
I don't know, right? We've had Paramount shareholders, or we've had kind of Paramount and David Ellison lobbying people in D.C. and Europe. We've had Netflix going ahead of the Senate last week. President Trump had said he'll be involved, then he said he's not involved. What we do know, just as a kind of basic set of facts, is that the DOJ is looking into both cases and has yet to say whether or not it's going to challenge either of them.
In terms of timing, is there anything pressuring? Is there any date, any number, any time frame that we look to for the next?
Yeah, the next big one is the shareholder vote, really. We're expecting Warner Brothers to arrange a vote of its shareholders sometime probably in mid to late March, kind of at the latest, early April. That's something of a deadline for Paramount, because they need to convince a bunch of shareholders before then to change their mind. Otherwise, then they're really up to the whims of regulators, because if it gets to shareholders and shareholders do approve that Netflix deal, there's not much Paramount can do besides hope that the government in the U.S. or Europe blocks the deal.
Lucas Shaw, we appreciate you on the story. Meanwhile, coming up, We're going to talk about how the storied VC firm Andreessen Horowitz is helping drive the Trump administration's AI approach. That's next. This is Bloomberg Tech. Time now for Talking Tech, and first up, Stripe is arranging a tender offer that would value the company at $140 billion. Now, according to sources, that marks a roughly $30 billion increase from the most recent valuation last year. The move is being seen as a sign that the mighty fintech may continue to delay its initial public offering. Plus, Cadence Design Systems is introducing a new AI tool designed to speed up semiconductor development. Now, the company's new ChipStack AI super agent, well, it will act as an assistant to engineers, helping with design, debugging, blueprint generation. Look, the move comes as the tech industry really grapples with the surging chip demand and ongoing labor shortages. And Alibaba, well, it's pushing further into robotics. The company has debuted a new AI model called Rin Brain, designed to give robots a more advanced understanding of their surroundings. With the release, Alibaba takes on AI leaders such as Google and NVIDIA. Ed, what have you got?
Okay, so Andreessen Horowitz has become one of the most influential voices shaping the Trump administration's AI policies. Sources say the venture firm is often the first outside call that top White House officials and senior Republican congressional aides make when weighing moves that could affect tech companies' AI plans. And like a lot of this reporting, Caro, it's coming from current and former White House officials. There are things that are clearly in plain sight, right? So Sriram Krishnan, who is a senior AI policy advisor to the president, is a former Andreessen Horowitz partner, but he was in London. And there's reporting in there about, David Sachs, who is from the world of venture capital in Silicon Valley, is close to the president and wants to hear out industry. And Andreessen has scale.
Has scale. It has money to put into super PACs. We see what they did with the crypto fair shake and the way that they've then retargeted in the AI spectrum. But what's also interesting is one of the lines in the story says they de facto have a veto, really, over certain AI policies. Now, they push back on that. In particular, the named lobbyist for A16Z says, look, the only person who's got AI veto is President Trump himself.
Yeah, the president makes policy, but, as we've reported, he often gets handed the docs, reads them himself, and says, good call. Coming up on the program, Runway CEO Cristobal Valenzuela will be with us to talk about the startup's latest funding round at a $5.3 billion valuation. It is halftime, and that conversation is coming up next. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. Let's check in on the markets that are actually giving away some of their gains that we had earlier in the session. We're now unchanged on the Nasdaq 100. We're trying to digest the retail data that we got, which was weaker than expected. But what does that mean in terms of the Fed and its ability to cut rates more broadly? But also, where are we buying back into? Is software still loved at the moment, having been so beaten up last week? And the hardware sell-off is just a little bit crimping some of that risk-on feeling of the day. I'm looking at a risk-off feeling in crypto. Bitcoin off by 1.4%. We're still at 69,000, so well off the lows of last week. But it's still the moon music, not strong, particularly in ETH. We're off by 4.6%. So still looking for a direction and really where the asset class buying comes and steps back in. Move on to what's happening underneath the hood of the benchmarks, because, look, we are seeing significant gains for Spotify. I might add it was been crushed leading up to these numbers. So we're still down on the year. In terms of a one-year basis, we're up 15%, almost a record move on their shares after their addition to monthly average users really eclipsed expectations. Snap gets an upgrade, it's really seeing that you could be buying into the strength of subscriptions for this company. Datadog, check that out, up 16%. Again, software was beaten up, but Datadog giving a earnings report that steadied some of those nerves, Ed.
Joining us now is Bloomberg Equities reporter Ryan Veselika, who, I don't know how he does it, but he's across the entire lot. I think let's start with the earnings part, because that's probably more common to some of the bigger movers, right, across the markets this morning. Spotify, Datadog. What are the trends we're seeing, and what's the action in the moment telling you?
Hey, good morning. Thanks for having me. So a lot of these companies have gotten beaten down, as you mentioned, but they did a lot to reassure investors about some of the bigger concerns that are facing them. So in Spotify's case, they give a very strong outlook for their user growth. They gave a very strong outlook for their margins, both of which help to address key concern that people have been having. Spotify, I think, is up by its biggest day, I think, in several years by now. So certainly a relief rally there. Datadog, another company that has been really beaten down as part of the ongoing rout in software stocks. Strong revenue forecast there, and the full year revenue forecast, I think, was a little bit under expectations, but at the same time, analysts said this looks like it could be conservative, really helping to ease concerns about what is the impact that some of these software companies are going to see from AI-related services.
That's it, isn't it? That's the read across. It's how much is AI going to be eating any of these companies' lunches? And
Absolutely.
Must be the desire of the executives right now to push back and to show real operating margin growth, and in particular, real revenue. I mean, Datadog was up 29% for their last quarter just gone.
Yeah, absolutely. Now, I will say that not all of the results have been strong. So yesterday we got results from the company called Monday.com. That stock fell 20%. I think that one wasn't strong enough to help ease some of these concerns that have persisted around it. But Datadog is the one that I feel like you hear a lot of people talking about when you look at the overall software weakness. This is one name that gets singled out repeatedly as one that was sort of thrown out with the bathwater. So maybe overdone selling there. Certainly the results here are giving the bulls something to cheer about.
Bloomberg's Ryan Vlastelica, thank you very much. Let's go to the private markets in the world of startups. AI startup Runway hit a $5.3 billion valuation after the company clinched a new round of funding, raising $315 million. Here to discuss Runway CEO Cristobal Valenzuela. I was reading all of the different reports about this round, and we'll get to the money part. But I think what's jumping out at me, Cristobal, it's great to have you back on the program, by the way, is the need to make models that are more useful, that can do more.
Correct.
Do you think that's a fair place to start?
It is, and thank you for hosting me again and having me here. It is. I think it's a reality of where the technology is heading and where the models are. We've seen this a little bit with language models, but now I think world models are basically eating research and eating AI. It's kind of clear that the next frontier of what we expect to see progress in all modalities will come from video and from models that can understand and simulate the world. And so a lot of what we're doing with this new funding is to basically double down on that vision and that mission, which I think we've been first to market on many other parts of AI, including, of course, video generation. But now it feels like more present than ever, then world models will start really unlocking the next stage of AI progress.
You may be a little beaten down by this story and line of questioning, but the capital is for compute, or it's for talent, or it's for both. And give us a sense of what that environment is right now.
Yeah, it's for both. I mean, the growth of the company stems from how we allocate these resources effectively. And look, we've been a very focused and very efficient company at spending what we've raised in putting it into compute, into training some of the world's best video models out there, and hiring. For the impact that we've had as a company and for the kind of customers and enterprises that we serve, we're a very small team. And so right now we are scaling that. We are hiring across the board, more researchers, more great talent, and of course, double down on compute, which is fundamental if you really want to get to the next stage of what we think will come.
The kind of customers you serve, Cristobal, who is that then? As we still typecast you as an AI video generation company, but you're not. You're a robotics company, you're an avatar company, you're a world company. So who do you serve?
Yeah, of course. That's a good question. So, look, I think it's important to understand how AI has progressed. And language models are basically describing reality. World models are simulating the world. And when you simulate the world, you can start tackling many different kind of industries. So the question of will AI models will help advertising, marketing, Hollywood, media, I think that question is answered, and the answer is yes. It's kind of a pretty obvious yes to these days. And so we're the best company and the best kind of solution for marketers, media, Hollywood entertainment. We've been doing this for quite some time. And so I think we've won there, and when we continue to grow, there's a lot of expansion that we have to do in the industry there. Now, the models can simulate the world. So we started to simulate not only media and entertainment, but we started to simulate how the world works. And that is effectively very valuable for robotics, for physical AI, for AV. And so another way of thinking about it is we have some of the best tools to create media and videos for humans to watch. We now started to create videos and media for robots to watch. And for those robots to learn from that data, which is fascinating.
It is fascinating. It also has different impacts on different people. And when you say it helps an industry, it's kind of in the eye of the beholder. Cristobal, talk to us about how you think about, as the leader of your business, the implications this has for the labor market, for what it means more broadly, for humans watching content that wasn't made by people and the reality of them.
Yeah, look, that's a question that we've tried to grapple for a long time in terms of how do we make sure that companies and industries react accordingly to what's coming and what's happening. And I think my take after seeing the industry for quite some time is I think the industry is adapting pretty well, to be honest. If you look at advertising agencies, if you look at Hollywood, it's pretty obvious these days that every studio has an AI department, an AI kind of function, an AI chief, and the organization has started to rethink themselves in an AI for native world. And that has allowed themselves to really find new jobs, new types of things that they weren't able to do before. So in a way, that's taking some of the tasks and things we've seen in the past, and that will go away. And that's natural. I think that we've slowly realized that that's the case. At the same time, we've seen more jobs being put out there with new descriptions on things that even a year ago would have been unthinkable of. And I think that reaction is now becoming obvious, not only for media, for Hollywood, but for gaming companies and for many other industries, even for software engineers. I think it's kind of pretty obvious these days where you start to see that you can automate and simplify a lot of the entry-level tasks and jobs. And so that's where I think we will continue to see growth industry-wise in media and entertainment.
Cristobal, we find that there's a lot of interest in Runway, right? As a company, how the models are being deployed and used, commercialization. This was a big round. The valuation is interesting. A lot of the questions we get for you about your future and whether you plan to go public. So I'd ask you to kind of be candid about that, the benefits and negatives of being a public company and why you might consider doing that.
It's not something we've not considered at some point. I think right now, given the breadth and research innovation that we conduct at the company, I think we're in a much better position thinking about being private for a bit more time. I think there's trade-offs as being a public company in terms of how you report, how you think about your growth, the kind of things that you need to focus on. Right now, for me, this is an area of unique frontier research, and being a private company allows you to do that frontier research in a much more with much more freedom. And so it's something we wouldn't necessarily not consider, but right now, given the growth that we see, we'll probably remain a private company for quite some time to retain their independence.
Cristobal, briefly, I sort of asked you about whether the employee base in companies are ready. Am I, as a human, ready to digest the wall of AI-made content and discern what's real and what's not?
Yeah, that's an interesting question. I actually will kind of flip the assumption there. I would start to assume, and I would suggest everyone probably starts to assume that most of the content that you see out is going to be generated. And in that case, what we should be kind of watermarking and protecting isn't necessarily the generated content, is the real content, is the content that we've seen and we've recorded from a camera. And that inverts a little bit the problem because yes, more content will start becoming the norm. More AI content will start becoming the norm of the content we interact with. Specifically when you can also do it in real time, which is going to be a fascinating new avenue of gaming and nonlinear experiences. I think the world is adjusting to that. There's definitely a cultural and social adjustment period, but from what I've seen, I think it's happening faster than ever before, and just prepare because it's going to get even more crazy.
Cristobal Valenzuela, Runway CEO, it's great to have you back. We appreciate it.
Of course. Thank you, guys.
Coming up, ahead of a landmark addiction trial, Meta ran thousands of commercials to promote its safety work with teens. Details on that next. This is Bloomberg Tech.
Instagram owner Meta paid for thousands of TV commercials that promoted its safety with teens, all ahead of a landmark case examining whether the company intentionally designed products to hook children. Bloomberg's Kurt Wagner, who leads our coverage of Meta, is here with us. This is about timing and proximity to events, but what do we need to know in our reporting.
Yeah, so the trial is sort of the backdrop of this whole thing. That started yesterday in Los Angeles. As you point out, the allegations here are that Meta and YouTube and others have created these products to addict young people, you know, the infinite scrolling, the algorithms, things like that. And so these advertisements that Meta's been running for a while, but really in earnest since November, promote their teen accounts and all of the stuff they're doing to try and help and combat this issue with teenagers. And so, again, timing is interesting here. They're trying to sort of set this narrative about themselves with the backdrop of this trial going on at the same time.
Now, in the story, it talks of Tech Oversight Project Executive Director Sasha Howarth really talking about this as being an influence play. But in many ways, to take the other side, it's meant to be an influence play for parents, for kids to understand that these tools are there for them to use, right?
Exactly. And, you know, you think about if you're Meta and you're sitting here going, okay, there's going to be this landmark trial. And in fact, there's going to be trials for Meta around child safety and teen safety throughout the year. And so if you think about there's this steady drumbeat of headlines and news and coverage about that issue, you certainly want to have your viewpoint out there as well. And so I think that's why we see them promoting these teen accounts, which they rolled out about 2 years ago. And really trying to your point, Caroline, show parents that, hey, all these things you're reading in the press, like we are addressing them with these safety settings that we've put in place as well.
Bloomberg's Kurt Wagner, we thank you. We're going to talk more about that story in a moment. But first, Ed, you got some breaking news.
Yeah, my understanding is that Tesla has promoted Joe Ward, who was the vice president leading the EMEA region operations, to basically run sales, service and delivery globally. All those teams around the world are now reporting into him. We don't know that much about Joe Ward. I think he started at Tesla as an intern quite a long time ago, has kind of climbed up the ranks and been based in Europe. But you'll remember yesterday Bloomberg had reported that Raj Jagannathan had left Tesla and he had been running the sales org. And, you know, we try and track this because of how it runs with everything kind of filtering into Elon Musk. Ultimately, we'll keep tracking it. Karen.
Yeah, EMEA sales, they've been tough of late. Now, let's just return to our original conversation because, as mentioned, it's not just Meta that's currently under scrutiny over safety, particularly for teens. Other tech giants, think Google, with its YouTube, are facing lawsuits as well over the addictive nature of social media. Let's get more on all of this. Eric Goldman, he's a law professor at Santa Clara University School of Law and co-director of the school's Center for High-Tech Law. Eric, as I mentioned, it's Meta, it's Google, it's also Snap and TikTok facing legal focus throughout the year, correct?
Yeah, there's a trial taking place right now in Los Angeles, putting all four of them on trial. There's also a federal case that's putting them on trial in June. And there are lawsuits against all of them throughout the country in parallel with that.
The argument at its core from some of these so-called victims are that these tools and these platforms were designed to hook teens, young brains in particular, and keep them coming back for more. Eric, is that the understanding you have? What legal credence, what fight do they have to fight here?
So the basic argument from the plaintiffs is, as you described, that the sites were designed to intentionally addict users and that the services are therefore liable for the harms that resulted from that addiction. There's a lot of questions about that. For example, we have to ask, what does it even mean to be, quote, addicted to a social media service? There aren't medical or psychological definitions of that. We also have to talk about whether or not the services caused the harms that the victims have suffered. There are many causes of harms in people's lives, and so isolating that causation is going to be tricky for the plaintiffs as well.
Let's get Meta's response to these lawsuits in questions, right? The company says that they don't reflect reality. The evidence will show a company deeply and responsibly confronting tough questions concerning research, listening to parents, academics and safety experts, etc. That's the company's reaction. Actually, what's happening in response to the wider issue is you see state by state different laws being enacted that are consistent with the complaints of the plaintiffs. That's my read of it, Professor Goldman. Is that a sort of useful strategy towards a solution here?
I think you need to be careful about using the term solution, because in order for us to talk about that, we have to be very precise about exactly what problem we're trying to fix. There are a lot of problems in our society, a lot of problems plaguing kids. And there are also problems of over-responding to the content online that looks a lot like censorship. And so when we talk about solutions, we can't do that without talking about the problems. Having said that, I think that we're going to see a battle of experts in these trials where both sides are going to bring in the best and brightest minds to tell their case to the jury. We're going to hear from average Americans, essentially plucked off the streets, who are going to weigh that evidence and try and tell us whether or not they think there's a problem here that needs to be addressed.
Professor, in the course of proceedings throughout the trials, those that are kind of trying to come to a decision in them, those presiding over the case, to what degree do they have expertise in the technicalities behind this?
So ideally, the jury doesn't have any direct expertise they're bringing in. The idea is that that's not what they're being asked to do. They're going to be presented with evidence from experts that have been chosen by the parties, and they're supposed to sift through that evidence, discuss it, evaluate it, and try to say which they find more convincing. So in that sense, I think it's even better for us that it's not a panel of experts trying to decide. It's really a bunch of what we hope are well-meaning Americans who are there to just tell us, I'm not going to respond to the hype. I'm not going to listen to the critics in the media or the plaintiffs' lawyers and the politicians per se. I'm going to listen to the evidence.
Eric Goldman of Santa Clara University School of Law, thank you very much for your time. Now, coming up on the show, Lyft's earnings are out later today. We're going to preview see what to expect. That's next. This is Bloomberg Tech.
Lyft earnings, they're out after the bell today, and less than a week after rival Uber kind of disappointed investors with its profit outlook. Let's talk about what we can expect from Lyft with Bloomberg's gig economy reporter, Natalie Lung. We are expecting pretty healthy gross bookings, right, for the fiscal quarter just gone.
Yes, if Uber's earnings was any guide, they posted pretty strong 4Q, and Lyft is also expected to post pretty strong growth there, one of the strongest growths we've seen in nearly 2 years.
Natalie, Uber used its earnings to position itself structurally and from a personnel perspective for its robo-taxi era. You know, we've spent a lot of time with Lyft, who plan to do the same, right? What do we expect them to communicate in earnings in that respect?
Mm-hmm. Lyft is going to roll out AVs in a couple of cities this year, as they announced last year. Those are Dallas and Nashville. So we might hear some of their rollout plans today, and also hear them talk about how their fleet operations unit subsidiary FlexDrive might help with that.
And Dave Risher and the team of late have really got the memo that they need to go global. They've been making M&A. How is that speaking to the growth opportunity here?
So the fourth quarter will be the first full quarter where they take into account the European business, FreeNow, which is the taxi app in Europe that they acquired last year. So they might get a boost there. And they've also acquired this chauffeuring business, which is like this high-end rides type, which could also bode well for the bottom line.
Did Lyft actually do anything in the quarter, Natalie, that you kind of think might give them a little bit of a boost? Is there anything that they've already announced that we think they'll show traction on?
So last year was a big year for their Silver product, which is aimed at elderly users. They simplified their app interface for users, so there could be a boost in the rider base there. They also boosted a lot of their partnerships. In November, they announced a partnership with United Air, letting people earn miles if they connect their accounts with Lyft. So that might attract more businesses there, like on airport rides too.
How are they in terms of scale versus Uber? I mean, at the moment, analysts really like the stock. 15 of them say buy, only 2 say sell. But is it a like-for-like comparison here? Are they always going to be the second fiddle?
Yeah, like Lyft's business is, 30 or 20 to 30% market share in the U.S. and they're just starting with their global expansion compared to Uber, which is already in more than 30 countries. And so there's still a lot to catch up there. But we know Lyft is on track with their 3-year targets too.
Bloomberg's Natalie Lung, thank you very much. I mean, the earnings in the moment carries Spotify on track for their best day in about 7 years. 38 million subscribers added, quarter gone, 751 million total. It was all about the Unwrapped. My average age, 37-year-old listener, apparently.
I think I pipped you to the post with a 32-year-old listener, but I thank my kids for that. That does it for this edition of Bloomberg Tech.
Check out the pod. You know where to find it. This is Bloomberg.